Thank you. Thanks a lot, John, for the introduction. Um, as John has stated, I'll be making the first part of today's presentation, and I hope you can all hear me. Um, so this is our outline. The presentation is made by myself and Leo, of course. So the outline, as John has stated, I'll begin with the background and just a brief introduction in addition to what John has already stated. Then I will define economic freedom. And again, as John has stated, the reason behind this is because we want to see how taxation or tax policies proposed, how they relate to economic freedom and what implications that has for economic growth. So then I'll very briefly take us through the some of the main purpose and objectives of taxation, and then we will now go into the substantial discussion of balancing economic freedom and taxation. And what we did here was basically to look at a few laws. Taking the finance bill, for instance, we looked at some of the proposed amendments in the three laws that John has mentioned. That's the income tax, VAT, and excise duty. We'd initially intended to look in detail at the other two, but for today's purposes, we will just focus on the first three, and we will show the balance between our analysis of these acts and these proposals and how it relates to economic freedom. And then Leo will do the last part, which he will be discussing some of the key lessons and recommendations. And I should mention that he'll also do the analysis on the VAT Act and Excess Duty Act. So that's the outline. We go to the next presentation. So in addition to what John has already stated, because that was the rationale that informed our preparation for this webinar, it was basically necessitated by recent developments that we've seen in the country, and particularly what we've been observing on the taxation landscape. I'm pretty sure, as John has mentioned, most of you here have already been privy to the national discussions we've been having on the finance bill. And prior to that, we had the national taxation policy had been released by the National Treasury, and our broad review or analysis of the two documents suggested to us two things. We thought, from what we could observe, that either the policymakers or the drafters of this document have an insufficient recognition of the need to balance taxation measures or taxation proposals and economic freedom, or they just have an arbitrary, or rather just doing an arbitrary violation of some of the main canons of taxation, which of course has various implications for growth of revenues which they intend to collect. And it has basically negative implications in terms of meeting the intended tax objectives. So we looked at the national taxation policy initially, and then when we had the finance bill, we also did an analysis of various the various amendments proposed, and IEA has a memorandum to that effect. But we thought that we should convene a discussion with some of the stakeholders that are interested in this debate, and those who engage with the Parliament, with the executive, and hopefully we'll also share some of these recommendations with the different policymakers, because we think it's critical for them to be able to understand that it's necessary to strike that balance. So for this webinar, we will demonstrate that link and illustrate the effect that the different proposals have in creating like a favorable environment for business and investment. And then we will also try to demonstrate that certain tax rates and the complexity in some of our tax laws, the effect is that it creates burdensome compliance requirements, and contrary to what the expectation would be, it ends up limiting economic activity and reducing efficiency. So that's our background. Then we go next to basic definitions, so that we are all on the same page by the time we come to understanding the topic, the essence of the topic today. So economic freedom is basically has been defined by the Heritage Foundation together with the Fraser Institute as the ability of individuals to make their own decisions without interference, coercion, or with as minimal limitations as possible by government. So those of you who have attended some of our previous webinars, this program always annually convenes a webinar looking at the Index of Economic Freedom. And some of the basics or the measures of that economic freedom are partly what is applied to this discussion because it has an obvious effect in terms of facilitating or allowing for the business environment or for an economy to thrive. So from their definition, the cornerstones, from the definition of these two institutions, like the cornerstones of economic freedom, I would say, are basically personal choice. There's the issue of voluntary exchange. There is another issue of freedom to enter and compete in markets, and protection of persons and their property from aggression by others, including the state. So individuals usually should have economic freedom, or we would say that individuals have economic freedom when the property that they acquire, either they can be able to utilize it without the use of any force. First of all, the acquisition of that property should be without force, fraud or theft. It should be protected by the government from physical invasion. They should be able to use, exchange, or give their property to others with as minimal intervention from government as possible. So broadly, that is what the definition entails, and some of the key components or the measures that annually comprise that index that we normally measure. We have issues around property rights, rule of law, free trade, limited government intervention, and basically it's an assessment of trying to check what the implications of all these pillars on an economy and in facilitating business. So next, that stated, having looked at economic freedom, we look at now taxation. This most of you, of course, already know, but just basics. Looking at the purpose and just understanding taxation. In a very basic way, the definition of taxation is basically the imposition of a mandatory charge or other levies by government on individuals or legal entities, primarily to raise revenue for government expenditures. There are other objectives. The intention is not always to raise revenues, but we'll discuss that shortly. And it's also defined separately or variously as a mandatory payment or charge that is collected by government or the state from individuals or businesses. I think as simplistic as this might look, it's useful for us to define it because part of the contention in the debates currently on the finance bill, and I think which Leo will talk about in terms of the housing levy, there have been questions: is it a tax? Is it a levy? Is it what is it? And what does the definition alter the characteristic, or does calling it one thing or another, what effect does that have? So Leo will explain that in detail, but I think it's useful for all of us to be on the same page in terms of the primary definitions. Then in terms of the purpose of taxation, and this is useful for us to be able to understand again why it links or how it links back to economic freedom, and what deviating from an intended purpose, what implications it has on economic freedom, and eventually what implications that has on meeting the targeted objectives. So the primary purposes of taxation are the 4 things that we've listed there. So first, we have revenue generation, And here, this is the obvious one. It's basically that taxes help government to raise the necessary funds that would be used to finance public expenditure and basically cover the various costs of running the government. Linked to that, second is provision of public goods and services. And here, basically, we know we have the definition of public goods, but of course, government has the primary role of providing these goods, or government is best placed to provide public goods. And the way in which this is done is mostly because they have funds available in the form of taxes and other revenue. So basically, that's the second. And then the third purpose or objective is redistribution of wealth. So here, it's argued that taxation usually can help to reduce income inequality. And I'll talk about this again shortly when I go into the canons of taxation, by collecting a larger share of income from higher earners and using those funds to support the social welfare of others, or those that are not as high earning as the rest. Then lastly, the last objective is on economic stabilization. And basically, here we're saying that tax policies can be used to influence the economic activity, the nature of economic activity or economic behavior, and stabilize the economy during different times, for instance, times when we have high inflation, such as what we have right now. So just to reiterate that it's important for governments to then strike the correct balance in taxation in order to ensure that the burden is distributed fairly and economic growth is not hindered, and that they are able to maximize the welfare. Yeah, so next. So that stated, why should we or what are the approaches to understanding or looking at the balance between economic freedom and taxation? So one of the approaches that we took to be able, as John said, there are different ways of dissecting taxation policy, but one of the approaches that we took to be able to understand this is by approaching it from the canons of taxation perspective. So balancing economic freedom, it's useful to check to what extent taxation adheres to the different or the indicated canons of taxation, because the moment it deviates or the proposals deviate largely from these canons is when we begin to have the effects that we will discuss later on. So we have four broad principles or canons of taxation, and this simply refer to characteristics, the characteristics or the qualities which a good tax system should possess. These principles, the four of them, the canon equity, certainty, convenience, and economy were first proposed or were first developed by Adam Smith. Most of you who are here, I believe, are familiar with this renowned economist. And these canons have been documented in his book, The Wealth of Nations, which is usually a favorite of most of my colleagues. And we often suggest for different scholars or policy actors who are interested in economic policy to just familiarize themselves with the main principles in that book. But part of that was the canons of taxation. And what Adam Smith was basically saying here is that proper tax policy should adhere to four basic rules and principles. And these are the ones that we've listed here: the equity, the certainty, the convenience, and economy. To explain just a little and provide a little detail in terms of equity, because this will help us again see the relation between this and the proposals that in our taxation laws that we have, and how those again are advancing or limiting economic freedom. In terms of, if we look at equity, so this principle basically suggests that persons who earn or who are paid more, or firms that make a little more money should be able to make payments that are proportional to their income. And that usually implies that if a person earns, say, a little more, then they should be able to, it's commonly referred to basically as the ability to pay principle. And the idea that is behind this is that the people who can, again, as I mentioned, be able to afford to pay, then they should be able to pay as much. But of course, noting that there should be a balance. You cannot, of course, overtax a certain category simply because, based on their ability to earn, rather based on their income only. It should be a balance, because again, as we will demonstrate, if you overtax, even if you're saying you're advancing the equity canon, if you overtax, then of course there are trade-offs to be made, and it has some implications on the resulting behavior of the earners. So it's a balance that should be made, but a key consideration. Then the second canon is uncertainty, and here it's basically refers to the certainty of taxation proposals, and implies that taxes, any taxation measure, should be clear and transparent. So what we mean by this is that any person or the taxpayer here, any taxpayer should be able to know for any tax that is imposed, how much they are required to pay, when they are required to pay, and how. Yeah, so how much they'd be required to pay, when they'd be required to pay, how they'd be required to pay. So those, in one way, that's one way of looking at the certainty. That helps, of course, with compliance, and just facilitates meeting the objectives of the tax. Then the detail of the third one, the third principle on convenience, basically looking at, it's linked. It basically refers to the timing as well as the method. So this one implies that tax systems should be designed in a way that allows people to quickly file and pay their taxes when they fall due. So in a sense, the canon of convenience has in the past been considered, or some people consider it to be like an extension of the canon of certainty that focuses more on the administrative process. And then lastly, is the canon of economy, or the principle of economy, which here basically talks about or refers to the costs of collecting taxes. So government should be able to strike a balance and ensure that the cost of collecting taxes is rational, so that it does not cost more to actually collect than the revenue that will be generated. It will beat the purpose. And yeah, so it would beat the purpose, and of course this would have detrimental effects to the public. So in a nutshell, those are that's what the core principles or the core canons of taxation mean. But then we see that there are challenges in terms of striking the right balance between ensuring economic freedom and taxation. So, for instance, when we talk about excessive taxation, for instance, our analysis has shown us that overtaxation would be counterproductive to the economy, because by violating these canons or by going against some of the objectives that are defined prior, and just using taxes, for instance, in a blanket manner to just generate revenue without applying the taxation, the purpose of each particular tax, it has various effects. For instance, it can reduce consumer demand, and this will be demonstrated in our analysis of some of the proposals in the VAT Act, for instance, and the Excise Tax Act analysis. It can discourage entrepreneurship because if, for instance, it costs you more to set up your business, and for the compliance requirements are hefty, there is really no incentive, or it drastically reduces the incentives of businesses and entrepreneurs to set up their businesses. And then so it basically the end result. So it does several things. It would facilitate tax evasion. It would reduce overtaxation. Can reduce the amount of foreign investment that we have. It can result in reduced savings. We have certainly seen that it's been leading or increasing public agitation, which of course can mean, and we've seen this happen in other countries, it can lead to political instability. So there's a number of repercussions for failing to balance the two. And so we see that sometimes high tax rates, the results ends up being diminishing returns, and overall it beats the purpose of the measure in the first place, which means it could lead to a potential reduction in overall tax revenue. So those are the challenges and some of the effects of failing to balance the two. Next. Then so in summary, this slide is basically to summarize what some of the taxation policies for economic freedom would look like. Beyond ensuring that the policies or the taxation laws adhere to or are rational in the sense that they meet the purpose or they are intended to meet the objectives, they should adhere to the four canons of taxation that I've mentioned. And we are suggesting here that the government should explore taxation policies that promote economic freedom, such as lower tax rates. Lower tax rates, of course, are not always an indication of a good tax measure, but we are seeing in most instances simplified tax systems, and this is in terms of predictability and uniformity, broadening the tax base, because equity, I think, in at least my interpretation of our own situation, I think KRA's interpretation of the equity principle, not only KRA, I'd say maybe the National Treasury, KRA, the other policymakers, it seems to me that the interpretation of equity is, for instance, making higher earners pay as much as they could, or pay a lot more, but they've forgotten that also broadening or ensuring inclusion of more people or broadening the tax base would also help them achieve the objective, the intended objective that they have for the different taxes. And this is just an example in terms of the Income Tax Act. So broadening the tax base is one of the other things that we suggest, and just ensuring that taxation meets the intended objectives. We go to the next slide. So, and having stated all that I have, we go now to begin to look at some of the amendments that have been proposed in the 2023 finance bill, and how from our interpretation, the balance, if they meet the balance, and what the effect of these proposals is likely to be. So I'll begin with the first part, which is the Income Tax Act. There are several proposals, but because of time, we highlighted just three. we have, again, as I mentioned, we have IEA's memorandum, which we shared with the Finance Committee, is ready and available. So it should be on our website back now, but if not, we will have it on our website at the end of this webinar. So it has more detail, but in terms of the three illustrations that I would take, for instance, I'll start with the first one of the sections of this finance bill. So we have section 9, excuse me, section 9 of the finance bill, which objective here is basically to broaden the scope of the turnover tax by including businesses with a turnover ranging from 500,000 to 1 million, bringing them on board, which were previously exempted. And then additionally, the proposal suggests to raise the turnover tax rate from 1% to 3%. So the reason why we're saying that we are not very sure that the drafters and the different policymakers had a keen consideration of the balance that they need to strike. For instance, with this one, we see that possibly or probably their intention was to boost tax revenue, or yes, the collection from the businesses. But our concern here is that it could inadvertently drive most of these informal or small businesses away. Remember, there's a lot of costs as well associated with setting up a business and compliance, and other forms of taxes that must be paid by the businesses and also by the persons employed by these businesses. So to avoid compliance, especially by the smaller businesses, we might see some of them adopting strategies to avoid this in the first place. So, and this would be, of course, not useful. It would be counterproductive for that proposal in the first place. So that's one instance. Another recommendation for an amendment in the finance bill with regards to the Income Tax Act is Section 24, which proposes to increase taxes for employees earning more than 500,000 per month. And again, if you try to understand the purpose of the objectives, again, it seems to point to basically the government, the purpose is likely to be just an addition, increased revenue generation. Actually, right from the highest office, I think they have not been shy to mention that their primary objective is to break up these revenues, ensure as much collection as possible. But what we asked ourselves when we were doing this analysis as IEA, what considerations have they made in terms of evaluating the composition of the different tax bands? So in looking at the formal sector and the persons in formal wage employment, did they actually consider, if that was the purpose, if the purpose is indeed to increase the revenue generated, did they consider the size of the group across the different tax bands, and do a possible simulation of what adjusting the rates based on the numbers in the tax bands would imply, or was it an arbitrary decision that because I mean, for persons, the few persons earning 500,000 and above can pay more, which is fine. We've talked about the equity principle and the ability to pay, but was there a balance between this and looking at the other tax bands and how it would actually generate more if they had a separate, maybe a different, they had a different consideration of looking how to an adjustment would be done for the other brackets. IEA has done our own analysis on what this what some of these proposals could portend, which we could share later. But I think there are more, just to say that there are more efficient ways to actually raise revenue if the purpose of the intention of this amendment was to raise revenue, which they have admitted as so. Then the last example that I'll give is on section 25 4B of the same finance bill. And this one relates to digital content creators, and it basically requires that persons making payment to this group of people will be required to withhold and remit 15% withholding tax. And it's now it's a blanket now requirement, raised from, I believe, was it 3 or 5% prior to this. So what my rather our issue with this, of course, we know that the digital space, and we acknowledge that the digital space has of course, given rise or created substantial jobs or provided new links for employment opportunities. And so, yes, indeed, the government should be able to raise revenue or to get, to raise revenue or get tax to tax this group. However, to ensure fairness and equity and all the other canons that I spoke about earlier, I think the same way, because for some of these content creators, digital content creators, they make quite a bit of money from these platforms. Some not as much, and in recognition of those differences between the ability to pay, then why not have a graduated scale? If this is pretty similar to income that has been made by this group of persons, we would suggest, or it would make a lot more sense to have a sort of graduated scales based on how much the content creators make. So I would not expect the withholding tax that would apply for a person who's made, for instance, 50,000 to be the same as that who has the one who's made 5 million. It would make sense to have a possibly graduated scale, again, looking at or doing all the requisite analysis of, because if they have that data of how different persons are making earnings or the scale of earnings on the digital platforms, and then use that evidence to design the proposal for the tax that would apply here. And this would, of course, not only encourage growth of the digital industry, it would also contribute to an increase in revenue, if that is the objective. And failing to do that, of course, would have adverse consequences where, as I mentioned earlier, it could discourage. This is just beginning now to be an avenue for employment. It could discourage creativity. It could discourage participation by the different, it's mostly the youth who are participating in this now. And this eventually would be counterproductive. So in summary, that's the end of my presentation. I think we go to the analysis of the other acts, which will be done by my colleague Leo. Thank you.
Yeah, so thank you so much. And my name is Leo Kemboy. I'm the program officer working together with Jackie in the Constitutional Law and Economy program. So we are going to go through, we picked select tax proposals in the Finance Bill 2023 to be able to so that we can use them to demonstrate the point about the economics of the economic freedoms. So so one of the things that is being introduced in the finance bill is the change of due date for withholding tax, and it's being changed from the 20th day of the next month after payment to 24 hours after payment. And that is problematic on several fronts. One of them being the fact that payment systems in this country, like the most commonly used EFTs, take 24 hours to reflect on the other side. So complying with that alone would be a problem. It's limiting it requires some level of automation to be able to comply. And that would also increase the cost of compliance. So, by the fact that a payment, by the time a payment is going through to and that withholding is already in place, it would have taken a lot of it would have taken a lot of cost and also time. So largely more people will not be able to comply with this because, as we all know, very few farms in Kenya have this kind of has this level of automation. So so this tax law is predetermined, is already set based on the fact that your payment systems and structures of the farm would be able to completely work faster. And the change of due date does not only apply to withholding tax, it applies to several other taxes, including excise taxes for betting farms, and across most of those payments that were due on the 20th day after of the next month after payment would now fall short within the next within 24 hours. So that's a problem. So this is a tax that is designed based on the level of automation. Secondly, there is no there's no enough time to comply, and that would be a problem. So another thing is the reclassification of exploitation of services from standard rated to exempt status. And part of the problem with this is now there's an implication that if you're exporting services, you now no longer be able to claim any input VAT, and so that would become an additional exporting entity. We know the principles of economics of tax law provides that one of the easiest ways to make people to on making people to comply is to provide them is to provide with a low rate. So in effect, if you are not able to if you are changing if you are changing the rate and you're not allowing farms to recoup that cost, you'll be able to create inefficiencies. Then of course there's an excise fee on financial transactions. So here they're changing the definition. In the past, it used to be costs on financial transactions alone, but now they're changing the definition to include excise fees on all. So if, for example, if in the past it used to be if you are withdrawing cash from an ATM, that aspect you would only be charged. But if a bank is of any service that a bank offers, any financial institution, for example, to give or digital lender, now you're increasing. They're putting excise taxes on those. So two things. First, the tax design is a problem. One, we know an excise tax is supposed to be a tax on the payment of a negative externality. So that's why when you start to query what exactly is that negative externality that a financial transaction, for example, provides, that gives that arm that is brought to the society, you won't be able to get it. So and then most importantly is that this would also increase the cost of borrowing. So people are seeing, especially the emergence of digital lenders, as a growth avenue. While in effect, if you look, So if you look at it from the other side, is that if most of these would most of these excise taxes would lead to increased cost of borrowing. So I've spoken about the two issues: increasing the cost of borrowing and the cost of financial transactions, because already firms would push those costs to the customers, and then also the question about the Pigovian rule, which is an excise tax has to pay for a negative externality. So that in effect is a problem. We also aspire to the national policy, economic policy has always been the fact that Kenya would like the financial inclusion to be spread and the use of the word financial inclusion. But if by increasing cost, the marginal cost per transaction, is the we know that the behavior nudge of increasing marginal cost per transaction would lead on the other side to people opting out of those services. Then obviously another issue is the question on mobile telephony, internet, fees on money transfers. Some of it some taxes has been reduced on some of the on a number of those, but they've put in new taxes on others like mobile phones and the rest. But the problem with telephones and especially internet is the obvious problem that first, some elements of service provision in this area, like some of those ADCO infrastructure, uh, 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 have a common resource element. And so one of the ways is you would want farms, you would want more households, you'd want you would want more households, more farms to uptake, to increase uptake in the internet services, because this is not a final good for farms. So like for us now, we're using internet to deliver a webinar, or you're using internet to automate factory processes. You're using internet for surveillance. You're using internet, so it's not something that you'd so first, that there's that element, but most importantly, so the most efficient trade-off is that this kind of a service should be actually cheaper in both in the short run and in the long run. That would be the most one of those important aspects. So part of these excise taxes will increase the cost, but most importantly, this would be inefficient trade-offs. Like the issue of the fees of money transfers. The CS National Treasury, as a paper, as a Brookings Fellow, when that he undertook as a Brookings Fellow, he measured the excise taxes on financial transactions and got it that it's 0.1% of entire revenue. So to him, one of the assessments he had is that it's minimal. But when he looked at the trade-offs by levying this kind of excise tax on financial transactions, he got that more trade-offs, more people were more people opted out of this, and part of the problem, and especially for those in households, low-income households, the at that time. So his conclusion, main conclusion of the paper, we can send that paper together with this link, is that together with the link of the presentation, is that this is an inefficient trade-off. You're collecting 0.1% of all revenue, but in the end, the opportunity cost forgone is larger than is bigger than the revenue. Then another proposal is security on appeal to High Court. There is now a requirement that before filing taxes, before filing an appeal with the High Court after the tribunal, you would be required, or a firm or a person would be required to deposit 20% of the tax in dispute, or equivalent with the commissioner. That has two problems. One, this is something that has already been decided. This is by all the way through the courts to the Supreme Court, which is case law, which is now almost like case law, that this is something that would be prejudicial. This is a cost when the liability, when no judicial decision has put forward a liability before. So it's a way of, it's a prejudice, it's a way of it's problematic. Secondly, the question is now when those firms or persons appear before the court, go before court and win judgments after depositing that 20%, that would also be a future liability to taxpayers, because one of the things, because people would want the sum, the deposit plus interest over that period. Because, and that's the problem, because in any case, if KRA wins, they would also collect the same with interest. So this is an exercise in futility. This is something that if it goes back again to the court, the same decision would be rendered. And this is legislation in vain. And this is one of the things that members of parliament need to understand, that when I, when I, when judges have looked at some of these decisions, and they've looked at common conventional conventions, practices, they've looked at case law from other jurisdictions with Kenya's with same protections in the constitution, and then again you bring again the same legislation. The same legislation has been invalidated on the other on from one side, and then again you bring the same that's legislation in vain, and that's uh, uh, wastage of parliamentary time. Then hidden in the finance bill again is a definition. So one of the as functions of the commissioner, there is a provisions that allow a commissioner to amend an assessment, an original assessment, even within the 7-year period. Now there's a definition. They're removing the word original assessment, which is to say that original filing of tax returns that you did, you're changing that part. Now they're changing the word original assessment to just say assessment. And the direct implication of this is that it could mean that you could be subject to multiple assessments and amendments by the commissioner of taxes. So this is a problem. The convention requires that double jeopardy, double you can't be if an assessment has been done once, that multiple that it doesn't envision fair administration action does not envision that you would be able to get those multiple assessments. But most importantly, taxation powers are constitutional powers and they are constrained. That's why uh, that application, multiple application, would even be prone to misuse, and that would be a problem. But most importantly is that this is something that will create unpredictability, which is something that is unlike in free markets that we expect. So that aspect of economic freedom, that predictability, that aspect of canon from the canons of taxation by Adam Smith would fail this route. And then the most popular issue now is the issue of housing levy. It's a legal mandate, mandatory. We're calling it also a forced saving scheme, a forced saving scheme. The way people are selling it is that this is a fund, a contributory fund, but the design as it is a tax based on two issues. One, that you are contributing to a fund against your choice, against your choice. Secondly, there are known in this issue of the design again, there are many unknown issues. So, for example, they say that in one, if you look at policy communication done by the peers, in one communication that the employer, you'll only get back your return, your contribution after 7 years, that the employer return would not be, the employer's contribution would not be returned. Again, you would be taxed in at one side. There are so many what information that you would not expect of in a savings scheme. You will not compare the design of this, for example, to a provident pension fund or any other saving schemes that people have. And then the rate of return, the law requires that the rate of the interest will be paid on the rate of return of the fund. But a simple calculation, for example, if you know the cost of money and that money has been provided to build houses at below the cost of inflation and also at below the cost of interest rates, that fund would be a reducing fund balance. So you'd be lucky to get even 1/3 of that fund, given historical projections of Kenya's inflation of 5% since independence after 7 years. And if we go to an high inflation era, if we are going to an high inflation era, that will also be a big problem. So, but again, if you try and ask the bigger question now, which is, what problem is this housing fund solving? Nobody is able to give an answer. But as economists at the Institute of Economic Affairs, we look at the census before we let our opinions guide us. We look at the census data. Census data, if you look at all census data, most houses in Kenya, most homes owned by households in Kenya are individually constructed. So in Kenya, we are not a market that purchase households where households purchase our houses, and this is guided by several things. One, the geographical the geography. If you're in an outer place like Kerio Valley, for example, where I come from, you would want a different kind of an house of an house. There are specific things you'll be looking for. So there are those preferences that you have. But most importantly, houses follow economic cycles. Most people most homes built in Kenya follow booms. Others follow. There are those who, when they retire, for example, like teachers, you get that lump sum pension. You're able to build an house. Houses follow certain things that necessarily are not predetermined, but mostly are predetermined by the foundational problem in economics, which is that expansion of output and more labor force participation. So if you look at that, but most importantly, the major problem from our assessment of the census data is that in Kenya we have a problem not with the quantity of the number of houses, but the quality. Quality. By quality, we mean some of those walls are not permanent. The roofing, the floor, the roofing, the floor material, and that kind of the thing. And the reason why that is a problem is because it's a fact. If you look at sectors like the cement, if you look at steel, most of those sectors are protected sectors, and those margins, you'd say equivalent of like margins. So those margins, our prices are very high in Kenya's prices in those area are very high compared to sub-Saharan African rates. For example, like for cement, if you compare cement between in Kenya and in Egypt, that's a different price. So what would be government intervention? What would be that housing reform that you'd be looking for? On the cost of land, for cities like Nairobi, Kisumu, Mombasa, you'll be looking at density, dense. So you need to make those regulations. You need houses that can go up. You need so the reform process for housing in Kenya is not a savings problem. It's not a savings problem. It's an entirely different problem that if you look at those problems. But what does housing levy do? It affects personal choice. We are not being given a choice to choose, for example, if I'm to save even, what would be the appropriate method? It's for that voluntary exchange, you'd have to accept houses built to some standard by government of Kenya. Again, the GOK, it competes with that GOK regulation role, which affects competition in markets. Now, and then again, it embeds inequity through redistribution. Because one thing that we've learned is that after 7 years, if you are given an house, you'll have to take a mortgage. How many people Kenya, if you look at the formal, a mortgage requires substantial income on a monthly basis, guaranteed income on a monthly basis. If you look at that, how many Kenyans would be able to participate? If currently the less structure of our labor market is 3 million out of 22 million Kenyans are in the formal sector who are guaranteed a regular income. So this is just another legal mandate solving the wrong problem. Now, one of the things that we did was to say, we asked ourselves the political economy question. Here is an aggressive tax bill, both in terms of the tax procedures, but also in terms of changes in rate. So we asked ourselves, the current problem now is the fiscal crisis. And the fiscal crisis, as we're being told by, and even the arguments that imploring MPs to take, is that we have a debt problem and we need to pay those to stay afloat. But we looked at, again, some papers, we 26 papers in total, but we chose 3 to highlight this problem. If in a scenario that Kenya has, as there what in that Kenya has, where you have a fiscal crisis, crisis that is spiraling out of control, and again, what would be the appropriate measure? So and we know that so that taxes for taxes and spending are some of the key levers that the economic policy that you can change. So so we looked at papers. One of the papers is by David and Christina Roma, and one of the things that they studied is they studied the UX tax code since World War II, data of almost 60 years. And one of the things that they found out is that a tax increase of 1% lowers real GDP by about 3% after 2 years. After 2 years, and this is something, and this is one of the things that, uh, uh, and this is one of the things that they observed. So this is an empirical study based on the on the US data. Another group of economists, Alessina and Adagana, studied now comparing if you have two options, either one increasing taxes or secondly increasing adjusting the fiscal or the spending side or the taxation side. So that found out that, for example, fiscal stimuli based on tax cuts are likely to boost growth than spending increases, especially when now that economic growth is weakening. Secondly, and this would fiscal consolidation based on spending cuts and not tax increases are likely to succeed in reducing deficits and debt and less likely to cause recessions than tax increases based fiscal consolidation. So that's a second study. Then there's also a study by a group of economists from the IMF. One of the things that they looked is that they looked at 170 fiscal consolidations in 15 advanced economies. And one of the so and compared that and found out that spending cuts are less damaging to short-term growth than tax increases. Then they found that spending a 1% spending cut has no significant effect on growth, whereby a 1% tax increase reduces GDP by 1.3% after 2 years. So we're asking ourselves this political economic question because we are seeing an aggressive tax bill that does two things. One is increasing rates, number two is expanding broad taxes broadly, even categorizing those taxes that are not supposed to be in place on things that like sin taxes on financial transactions, for example, which is like improper tax design. We are also seeing a tax bill that is emboldening a tax administrator. Then we're asking ourselves, from the economy, from empirical studies, would this work? And the suggestion based on these three studies as is something that says it won't work. So in conclusion, as I conclude, it's clear that taxation affects economic freedoms, and it affects economic freedoms in several ways. You're making the aggressive tax administrator aggressive. You're setting targets that will fail. And in this case, for example, requiring tax payments uh, within 24 hours, when you know, when based on the way processes and the level of automation of farms in Kenya, that won't be possible. You're appropriating more disposable income. So one of the things that we told that the Institute of Economic Affairs and told Parliament this year is that if you take all taxes, for example, the income tax, that 35% increase on income above 500,000 would yield minimal taxes. But again, if you take the data wage payments last year and do as declared by in the Economic Survey 2023 and provide a simulation of a tax a flat tax of between 22 to 24%, you'll get 576 billion, which would exceed the target. Then, obviously, it affects choices. A taxation, a legal mandate like the housing levy would affect choices. Then, one of the things that we really want to disabuse this notion that more or less taxes is an efficiency measure of government of Kenya's development trajectory. The foundational problem in economic policy that National Treasury should focus on is increasing output. How do we increase output? Which would mean you're increasing output in terms of growth, and secondly, output in terms of labor productivity, more labor force participation. How would you do that? And now, what would you? How now? Not to use the unconventional methods. Every tax has an opportunity cost, and that distortionary effect. So you are making a trade-off between revenue and choices for capital and income. You're also making trade-offs between revenue, national government revenue collected, and reallocation of capital. People would reallocate to sectors that they know the tax level is aggressive. Then there is an effect on poverty and inequality. So one of the things that we did was to study some previous public expenditure reviews. So the National Treasury's Public Expenditure Review 2017, their fiscal analysis found out that the VAT and excise tax increase poverty and have a small effect, negative effect on inequality. So another thing, there are no sunset clauses to those tax measures. And we know what Milton Friedman told, a Nobel-winning economist, told us about the permanence of a government program. There is no temporary government program. Just like the VAT on fuel, it was a temporary government program, supposed to go away after 2 years. It never went away. Then, of course, the tax code and structure of the economy go hand in hand. If you are proposing to solve an housing problem that is not there, that would require people to take mortgages, and you only have 3 million people in a labor market of 22 million, definitely tells you that you're proposing wrong measures. Then another issue is the size of government and tax code. Is it a problem? And this is a question that was raised during the debt when there was a national debt. The IEA raised during the national debt discussion when debt was going up rapidly. Is it a problem of revenues or is it a problem of spending? And definitely we know the other. So we're increasing. If it's the reflection should be which political choice would MPs make, and then the other issues that affect revenue, tax buoyancy, shock in income sectors of the economy. And then another two last issues that to be lessons and recommendations. The structure of the public finance management in law considers, requires that cabinet secretary makes it mandatory for cabinet secretary to always take the finance bill to cabinet and bring it to parliament. So it's a more omnibus legislation that would a revenue raising measure in Kenya would be an omnibus legislation, which is in form of finance bill, which has everything lumped up together, amending laws, including those retirement benefits for state officers like the president and the deputy president and the judges. So that is one issue. And first, if you look at even the EAC alone, in Uganda, the revenue raising measures do not go in a finance bill, they go in different bills. So different bills would be amended from time to time. So because it recognizes that a tax code and conversation about a tax code should be very specific. A shortened, if you shorten it in a form of an omnibus legislation, so many things would go through without studying those ramifications and the rest. But the second issue is that the law makes it mandatory, Section 41 of the PFM Act makes it mandatory for Parliament to consider a finance bill. Requires that no later than 90 days after passing appropriation bill, National Assembly shall consider and approve finance bill with or without amendments. So, and that's a problem. So we need to make that conditional. Not every time the tax code needs to be varied. The variation should come led by economic reasoning and evidence. Thank you. Sorry, it took a lot of time.
For taking us through. Thanks a lot, Kembo and Jackie, for taking us through a select examples or proposals, specifically income tax, VAT, and excise duty. Proposals obviously in the Finance Bill 2023 and the implication terms of economic freedom. So I will not, given that we only have a few minutes, I will not provide any further summary. I think we have done a good job at that. So without further ado, I would like to invite our participants. I know you're itching to ask your queries or make whatever comments that you may have. Feel free to either write that in the chat box or raise your hand, or and I'll pinpoint you to ask your question, and you can mention who you're channeling it to. You can even unmute your mic and just shoot, yeah. Yes, so far I don't see any. Okay, I see a hand there. Paris, please go ahead. You can introduce yourself and Paris. Wamala, Noah, my colleague, please go ahead. I see a hand. Paris, are you there? Yes, please go ahead. You can unmute your mic and pose your question or make your comment.
I've unmuted.
Okay, please go ahead.
Okay, so good afternoon, everyone. I'm Patrice Moshiri. My question is, with if the finance bill get passed as it is without any amendment, and then with the tighter monetary policies that have been implemented in the last couple of months, don't we see a contractionary economic growth in the coming months if the bill goes as it is, in case it doesn't get amended?
Thanks, Paris. So we'll take a round, the first round, maybe of 3 or 4 queries. Noah, did I see your hand up? Or Olunga, please go right ahead.
Yeah, good afternoon. My name is Paul Olunga from Nandi County. One of the canons of taxation is equity, but I'm still struggling to wrap my head around the fact that, despite the fact that taxation is usually mostly in percentage, why you feel like people who are earning more still need to pay more. Because, for example, the other canon is economy and the environment around it. And look at it this way: for example, the people who have been suggested that they're going to pay 35% from 30 because they earn above 500,000. On the flip side, we have a new system of funding the university or tertiary education, which basically, from the formula, the guys who are earning 500 are basically quote unquote rich, which means there'll be hard hit on the other side also, because now there'll be they'll be categorized under rich. Their children will be categorized under rich, so they don't qualify for any scholarship. Thank you.
Okay. I believe both Jackie and Leo, you are not in those queries and comments. Do you have a third one? Otherwise, any third question, at least for this first round? Okay. Let's see. Okay, so I would like to invite my colleagues. Maybe you could go, Jackie, you can go first. Maybe respond to Olunga's query on the question of equity. And then Leo, I mean, if you have any comments on the other query, you can still make. I mean, if you want to weigh in on that other one, you can still go ahead. And then Kemboy, you can the question.
Right. Thank you. Thanks, John, and thanks to Olunga as well as Paris for their questions. So I'll start with Olunga's question. So Olunga, what you're saying is that you're basically struggling to understand the rationale. If I got your question right, you're struggling to understand the rationale between the canon or the principle of equity, and particularly as it applies in our own tax policies here, in setting our own tax policies, and with the particular example of the income tax recommendation for a 35% rate for earners above 500,000. So I think, and I tried to mention that during my presentation, that in essence, the principle of equity basically just suggests, or what Adam Smith was alluding to, is that usually to spread evenly the burden of taxation and to ensure the welfare of different groups, that higher or paying earners or those that are wealthier should be able to pay a little more. If you look at it in that regard, it makes a little sense in terms because it's basically based on the ability to pay. However, I think what we are suggesting in our discussion today is that there has to be a balance. So you do not pick or overemphasize one principle, for instance, without looking at the ramifications or the consequences of using one justification to overtax any particular group. If you do that and overtax, for instance, the persons who've been said to be the highest income earners, it would have a negative or an adverse consequence in terms of generation of revenues. And that's why we spoke about our analysis or our thinking behind doing a simulation analysis to be able to show what the revenue would be if that principle was applied differently. So just to state that, or rather in my thinking, and any of my colleagues here can also add, just to say that these are core principles that basically characterize a good tax policy system. However, the government must be able to provide or ensure that there is a balance in the application of those principles, so that the burden, it does not end up overburdening one particular group, which in the end ends up being counterproductive to the intended purpose of that tax law. And you've given yourself a very good example that we also need to look at all the application or the interaction of all the other policies, all the other levies, all the other fees and charges that are to be made. And the funding for the university students, for example, is a good example, because increasingly then we see, and it just illustrates what we are saying, that by characterizing this group as the law has done now, it maybe the policy actors think that it's a positive kind of discrimination, but it's not. And by characterizing this, it's that they'll end up having to bear higher burden in in different other ways, which of course has an effect on the kind of disposable income they have. And what effect does that have? People will be creative in terms of finding ways to evade or avoid taxation, and this would be counterproductive for everyone. Then I will just say briefly with regards to Paris, and Leo will add. So she's just saying that based on this, because all indications are that despite the public participation, there is a high likelihood that most of the tax amendments will go through as they are. We hope not, but in case they are, I would agree with what you foresee, or possibly what you think you foresee, like a contraction in growth. And that's what we've been trying to demonstrate here with this presentation, that the policy makers, their intention seems, or they have expressed it as being raising revenues. That's what they have said, that primarily that's their primary, that's their primary objective. But looking at all the illustrations that you've made, including the examples that Leo has provided on what has happened in other jurisdictions, by all means, we are likely to see a contraction, in my view, in growth, because it would likely have negative, it would yield negative returns or growth in terms of what the revenues that would be collected. So I'll end there, and you can add.
So, the question about contraction, we've seen some already some business and membership organizations saying that there are sectors that would be rendered uncompetitive in comparison to the region. By there are some specific sectors that would require, and they've already projected some capital flight of Kenya shillings 150 billion, which might not be much more, which might not be more, but it would be significant if you comparing, for example, like manufacturing output is around $8 billion. So the the thing is, those taxes will have impact, and they have impact. The way we measure growth is if your projected growth next year, for example, is 6 or 7%, but as a result of an action, that changes behavior, like a tax, for example, brings that to 4 or 5%. That lost output, that output gap is what we measure that growth. So it's possible that those we'd see that some of those distortions, and the that we are not we are let's say some, for example, some positive adjustments like the one on VAT refunds could work magic to net off that distortionary effect. But we'll see that distortion. So the question about equity, uh, the thing is, the constitutional, again, because we are the Constitution Law and Economy Program, we have to emphasize this, that our constitution did not anticipate that the more prosperity you'll get, the more taxes and the more taxes would be levied against you or your farm. And that's why the constitutional protection of fair administrative, that taxation has to be fair. The taxation has to be fair. And fair in this case is that as a society, it has to be a fair rate, that we cannot have a question that the more you go up, your income goes up, the more you have to face. So we should embrace prosperity, and prosperity is a good thing. And that's why those ones of like 35%, are big issues, big political questions that need to go hand in hand with the constitutional protections. Yeah, and that's why it's a big problem. But one of the things that, just to contextualize what Tolunga said, is one of the biggest issues is in Kenya, the the most important constitutional provision is that on a structure separation of functions and the structure of our government. We've given Parliament powers. We gave Parliament in 2010 powers to determine form the form of our fiscal policy, and especially the taxes part. We require the same of Parliament to put their foot down and be able to look at each of those specific effects, whether effects of taxes, and even on fiscal policy, like the one of university education. If we are introducing this tax, what is the distortionary effect? Where is the evidence? What is the benefit? That all the things that are being done will not be legislation in vain, and that's a very, very important thing. Those that constitutional separation of powers between parliament, executive, and judiciary is that once a decision, for example, like the one of deposit, has been made by the Supreme Court, it cannot be reintroduced again in the finance bill. So you see, those things that already harm economic freedom are issues that should really be looked at carefully, including the one of university education.
Boy,
Back to you.
have we lost?
Back to you, Jeff.
Okay, sorry. I thought we had lost you for a minute. Oh, for some second there. Okay. Let's see. So I would like to invite our participants for the final round of queries or comments. I see one in the chat box. So I'll just read it out as I invite any other questions or comments. This is from Simon Kimuri. I guess this is related to this to Kemboy's presentation. So what Simon is asking is, what are the proposed excise taxes on mobile, internet money transfers, and the opportunity cost? So Kembo, you can just prepare to respond to that. But also to the two of you, as I invite more, any question, please also prepare your final remarks. In the meantime, do you have any other queries? Okay. Okay, so I see the time is actually our scheduled time, but maybe any final. I don't see. Okay, then, Kemboy, maybe you can respond to Simon's query and make your final remarks, and then Jack, you can follow thereafter.
Yeah, so the excise tax on telephone and internet would all be kept at 15%, with the exception of lottery, gaming, prize competition, and others, which is at 20%. So all of them would be at 15% range. So in conclusion, for me is to just emphasize that especially to everyone on this call, and what you already emphasized to members of parliament, that the each of these tax proposals has an effect on the economy and the efficiency, and it changes behaviors, it affects our choices, it affects our disposable income, it affects most of these things. And the more aggressive and the more aggressive and the more erratic the changes, the more annual changes that we see, and the more aggressive they make the tax administrator, and the unrealistic settings like requiring those payments within 24 hours, the more you encroach on economic freedoms. And that's a very, very important provision. That's a very, very important observation. And to say that here we'd require them to approach these issues with more circumspection, and the more, because some of these proposals are ridiculous, to say, and to quote another prominent economist, that most of this is like a dog breakfast. You throw in one good thing of on VAT refunds, and then you introduce an additional good and an additional bad and ugly things on the other side. So we want everybody to take a chill pill and be able to, that more evidence should guide how this voting is going to take place. But in essence, we'll be, especially things that are already decided, should not be on that finance bill. So thank you. To you, Judge.
Thank you. Thanks a lot to John for moderating this, and thanks Leo as well for sharing this presentation with me. So in closing, I'd just like to reiterate what we have said. We hope that the discussion today has been useful, because we've tried to demonstrate that economic freedom and the factors thereabout are a key driver of economic growth, innovation, and prosperity. And this is enabled by taxation, but there has to be a balance. We'd like, we emphasize, or rather I close by emphasizing that policymakers must strike the right balance between the two, which is remains to be the background of this discussion. And we hope that we've also shown you that excessive taxation ends up being counterproductive, has effects on hindering or discouraging investment, stifling entrepreneurship, and all the examples we've given here, which all lead or which all show or illustrate a likelihood of economic stagnation if we do not provide a proper balance between the two. So as I and as the CLE team, we continue to urge the different persons engaging with the policymakers. I know there has been that opportunity to share the discussion, to share our perspectives with them. We continue to urge them, together with the policymakers themselves, to carefully assess and evaluate the extent to which the tax policy, the tax proposals that they suggest take into account the likelihood of advancing or hindering economic freedom, because that balance would ensure or would incentivize productivity, and that's the only way we will end up meeting the objectives that are actually set as the objectives of the taxation. So that's it from us. We thank you again, before I hand this back to John, to all those of you who were part of this discussion, and we look forward to further engagement, and we will share this presentation. It will be available online.